So what we're going to do here this morning is talk about the case for better marketing. All right? Trying to motivate you on doing a better job of marketing. Some of you are doing pretty darn good, but we always get a little sloppy from time to time. We get busy and ignore some of the things that we should be doing. So this is kind of a reset, kind of a think about why we look at things the way we do with our Brugler program here. But I'd like you to focus on the impact that the price makes. All right? We've got a 12-month average price here. This would be the highest cash average price from USDA. You know, they publish a monthly average cash price. At 382, and that 186 bushel yield on that Illinois farm, your operator and land return would have been $131. I'm sorry, excluding including land return, but then you've got to put a land cost in there. Okay? And if that's $200 an acre, you actually lost $68 at 380 on that particular set of assumptions. All right? And yes, you've been thinking corn's a little close to break even. This kind of says that. Now, what if you go with a different price assumption? 321 was the lowest cash average price for USDA's monthly reports for last year. All right, so 321 was the lowest monthly average. The 382 was the highest monthly average. At 321, you're only $18 for operator and land return, and after rent, you're $181 an acre in the hole. Right? Why did we pick those two numbers? That's all marketing. Right? Everything else was the same. All your farming stuff was the same. Obviously, a higher yield would bail you out if all your inputs stayed the same. Right? 220 or something like that would help you if you keep the same inputs to get the 220 yield. All right, let's go to the third case. Now we're going to use futures. All right, third column over here, fourth column after their assumptions, is 301. That, of course, was the low futures price last fall, September board price, 301. So that's the worst case scenario on the board. There you were losing $19 an acre even before your rent, and you're talking minus 219 otherwise. All right? So that's a red number, red number, red number. Finally, let's look at the high board price, which was last June at 439. All right, that does quite a bit to help us. All right, now you're looking at $237 positive, and even after that, assume $200 rent, you're $37 to the good. All right, you see what I'm doing here? I'm just measuring the amount of your return that's based on your marketing. And let's just using this set of actual costs. The bottom line is that cash swing, just using the monthly average prices for the country for low and high, was $113 an acre for your marketing. On the board, you know, what you could have achieved potentially with your hedging and so forth was $256 an acre difference in your revenues. Okay? We tend to pat ourselves on the back because we got an extra 10 cents or we got the elevator to kick in an extra 5 cents on basis, right? These numbers are a lot bigger than that, folks. This is what we're shooting for, all right? How do we do a little better job of marketing? And then once you've identified the situation, you've got to ask yourself, what's the market usually do in this situation? Yeah, does it go up or does it go down? If in the past when we've had a situation that I now think we're in again, what did it do? Right? And now that I think I know what it's going to do, what do I do about it? That's the third step. Right? You've got to actually take that action. I believe it was Will Rogers that said, you know, you've got to get out of in front of the train, right? Or you get run over. You've got to actually move, right? So what are my sales or trading strategies to address those expectations? And then I think a fourth one that we overlook sometimes is, what's my tells or my hints that I'm wrong? All right, what's my backdoor strategy? here's what I think's happening, here's what I think I'm going to do. You should try and identify at the same time, here's when I know it's not going to work, okay? If I think this is the situation, the market ought to go up 30 cents between now and July. I'm just giving you an illustration. All right. At what point do I give up on that 30 cents? Well, it shouldn't go below X. All right. If we're at $4 and I'm looking for 4.30, I should have a chart number that says if it goes below 3.75, I don't understand something that's happening here. Right? Or 390, or whatever the number is. I should have that coming in. What's my bailout plan? All right? Or it can be in your strategies. If it's working against me short run, but I still think I'm right long term, can I do an option strategy that'll kind of pay me to wait? Okay? But again, I think this is fairly new stuff for us, but I think it's important to frame your thinking this way. Okay?